Investing is all about growing your money, but every investment comes with some risk. Risk is the possibility of losing some or all of your investment. Generally, higher potential returns come with higher risks. Understanding this trade-off is crucial for successful investing. When you invest, you hope for the best, but you must be prepared for the worst. That's where standard deviation comes in. It helps you measure and understand the potential ups and downs of an investment. Think of standard deviation as a measure of how bumpy your investment ride might be. A smoother ride means lower risk, while a bumpier ride means higher risk. By understanding standard deviation, you can make smarter investment choices based on your risk tolerance. Standard deviation is a statistical term. It tells you how much the returns of an investment have varied from their average return over a certain period. Imagine you have a mutual fund that has returned an average of 8% per year for the last 5 years. The standard deviation tells you how much those yearly returns have fluctuated around that 8% average. A high standard deviation means the returns have been more volatile, with some years much higher than 8% and others much lower. A low standard deviation means the returns have been steadier, closer to that 8% average each year. Calculating standard deviation involves some complex math, but you don't need to be a mathematician to understand it. Many financial websites and resources provide the standard deviation for mutual funds and other investments. Let's say you're comparing two mutual funds, Fund A and Fund B. Both funds have an average annual return of 7% over the past 5 years. However, Fund A has a standard deviation of 5%, while Fund B has a standard deviation of 15%. What does this tell you? Fund A, with its lower standard deviation, has had more consistent returns closer to that 7% average. Fund B, with its higher standard deviation, has experienced much wider swings in its returns. Some years it might be up 20%, while other years it might be down 8%. Imagine Fund A as a gentle train ride while Fund B is a roller coaster. Both will get you to your destination, but the ride will be much different. Which one you choose depends on your risk tolerance and investment goals. Standard deviation is often used with the 68-95 rule. This rule helps you understand the probability of returns falling within a certain range. For a mutual fund with a 10% average return and a 5% standard deviation, approximately 68% of the time, the returns will fall within one standard deviation above or below the average. This means returns between 5%, 10% minus 5%, and 15%, 10% plus 5%. Approximately 95% of the time, returns will fall within two standard deviations, or between 0%, 10% minus 2 times 5%, and 20%, 10% plus 2 times 5%. Remember, these are just probabilities, not guarantees. The actual returns could be outside this range, especially in the short term. Many investors assume that higher risk automatically means higher returns. While this can be true in some cases, it's not always the case. A fund with a high standard deviation might experience significant losses in some years, offsetting any potential for high gains. For example, consider a small cap growth fund. These funds invest in smaller companies expected to grow rapidly. They can offer high potential returns but also come with high standard deviations. If those small companies don't grow as expected, or if the market takes a downturn, the fund's value could plummet. On the other hand, a large cap value fund invests in established large companies considered undervalued. These funds typically have lower standard deviations and offer more stable returns but might not grow as quickly as small cap growth funds. Section 6, same return, different risks, choosing wisely. Let's say you're comparing two funds with the same average annual return of 8%, Fund C and Fund D. Fund C has a standard deviation of 3%, while Fund D has a standard deviation of 8%. Which one should you choose? If you're a conservative investor or someone with a lower risk tolerance, Fund C would be the better choice. Its lower standard deviation suggests more consistent returns and a smoother ride. However, if you have a higher risk tolerance and a longer time horizon, you might consider Fund D. Its higher standard deviation means there's potential for higher returns, but also a greater chance of losses. Section 7, real-life example. Seeing standard deviation in action. Imagine you invested $10,000 in a mutual fund with a 6% average annual return and a standard deviation of 4%. Using the 6895 rule, you can estimate the potential range of returns. 1 standard deviation, 68% chance of returns between 2% and 10%. 2 standard deviations, 95% chance of returns between -2% and 14%. This means that in a typical year there's a 68% probability your investment will grow to between $10,200 and $11,000. However, there's also a small chance, 5%, that you could lose money or see returns exceeding 14%. Remember, past performance is not indicative of future results. Standard deviation is just a guide, and actual returns can vary. Section 8. Picking your funds. Standard deviation as your guide. When choosing mutual funds, consider your risk tolerance. How much volatility can you stomach? Time horizon. How long do you plan to invest? Financial goals. What are you saving for? If you're risk averse or have a short time horizon, stick with funds with lower standard deviations. These are generally considered more conservative investments. If you have a longer time horizon and a higher risk tolerance, you might consider funds with higher standard deviations. These funds offer the potential for higher returns but also come with greater risk. Section 9. Smart investing starts with understanding. Standard deviation is a powerful tool for understanding the risk associated with mutual funds and other investments. By considering standard deviation alongside other factors like your risk tolerance and investment goals, you can make more informed decisions about where to put your money. Remember, investing always involves some level of risk. There are no guarantees, but by understanding concepts like standard deviation, you can make smarter choices and increase your chances of reaching your financial goals. Disclaimer: mutual fund investments are subject to market risks. Please read all scheme-related documents carefully before investing. Ensure you complete your KYC, know your customer requirements, and deal only with SEBI, Securities and Exchange Board of India, registered mutual funds.